Hello, and welcome to this lecture on the history and structure of the Federal Reserve System. In this class, we will introduce the concept of a central bank. Central banks exist all around the world. We will discuss the reasons why they were founded. What are their objectives and key functions? We will then focus on the Federal Reserve System, the central bank of the United States. We will discuss its foundation. We will examine the structure of the Federal Reserve System and its decision-making bodies. Let's start by looking at the world's oldest central bank. This is the Swedish Riksbank, which is based in Stockholm, Sweden. It is a fun case study that helps us to understand why countries founded central banks. It tells us what they hope to achieve. We are in Sweden in 1661. At the time, money took the form of heavy coins made from precious metals. These coins could weigh as much as 45 pounds. Not very convenient. So, in 1661, the Swedish king allowed private banks to print paper banknotes. This is what we all know today as paper money. This is much more convenient for banks and citizens. Why were people willing to accept these banknotes? Well, because the bank promised to exchange its banknotes against coins deposited in the bank. The banknotes were redeemable on demand. The banknotes were a huge success, but then the bank printed more and more banknotes. This led people to question whether the private bank would have enough coins deposited in its vaults to exchange all banknotes. These doubts led to an increasing number of people redeeming their banknotes for coins. This is an example of a bank run. However, the bank did not have enough coins to redeem its banknotes all at once. As a result, the bank collapsed. Despite this bank run, the idea of paper money was still popular, but it was understood that there was too much paper money in circulation relative to deposited coins. There was too much money relative to the amount of collateral held by the banking system. Hence, the Swedish Riksbank was founded in 1668 to control the money supply. The law required this new central bank to maintain the domestic coinage at its right and fair value. The law prohibited the Riksbank to print paper money at volumes that would cause inflation. The story of the foundation of the Swedish Riksbank showcases two important issues that modern central banks are designed to address. The first is ensuring price stability. Central banks are typically given control over the money supply. This control allows central banks to prevent too much paper money being printed. When there is too much money in the economy, this tends to cause price inflation. The second reason is that banks are susceptible to runs by fearful customers. To deal with bank runs, central banks act as a lender of last resort. Let me explain what this means. Banks borrow short-term and lend long-term. In our example, the Swedish bank borrowed metal coins in exchange for banknotes. It then used the coins in part to give out loans. So, at any point, there were fewer coins in the vault than banknotes outstanding. When everybody wanted their coins for their banknotes, the bank lacked the coins and could collapse. In modern banking, banks borrow cash from depositors and lend it out long term. They could also face a shortage of cash from time to time, even if they are making profitable loans to good borrowers. The lender of last resort function of central banks is designed to prevent the collapse of a healthy bank due to a shortage of cash. How does this work in practice? The central bank provides cash to the banks in form of short-term loans against collateral. This can happen during an emergency when the bank is stressed. Central banks typically accept many different types of collateral. Importantly, this can be illiquid long-term loans. That is, assets that would be hard to sell or that can only be sold with large discounts. For instance, today the Federal Reserve System accepts real estate and consumer loans as collateral for cash loans to banks. Let's now examine why the Federal Reserve System was founded. The Federal Reserve System is not the first US central bank. It is actually the third. There was the First Bank of America from 1791 to 1811 and the Second Bank of America from 1816 to 1836. However, these two earlier central banks were very different from what we today would consider to be a central bank. For instance, they had no control over the money supply. The United States had no central bank between 1837 and 1913. Money was issued privately, just like in our Swedish example. In this period, there were several banking crises, including a panic in 1907. During the 1907 panic, the stock market lost 50% of its value. Banks nationwide saw customers lining up to withdraw their deposits. The panic of 1907 illustrated the need for a lender of last resort. But it took some time and much political debate until the Federal Reserve System was officially established. On December 24, 1913, President Woodrow Wilson signed the Federal Reserve Act. What did the Act allow the Federal Reserve System to do? First, it gave the Fed control over the money supply. Second, the Fed could act as a lender of last resort to banks. The lender of last resort function has been used for interventions during times of market-wide stress. This includes the financial crisis of 2008 and the COVID-19 pandemic. The Federal Reserve Act established three parts of the new central bank. One independent federal agency, the Board of Governors in Washington, D.C., 12 regional Federal Reserve banks, and the Federal Open Market Committee, or FOMC. The Board of Governors consists of 7 members. The Board of Governors guides the policies of the entire Federal Reserve System. The 12 regional Federal Reserve banks are Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. The regional Federal Reserve banks were placed across important financial centers. This distributes power of the Fed across the United States. The reserve banks implement the Federal Reserve policies and function. For instance, they examine and supervise financial institutions, act as lenders of last resort to banks in their district. They also provide US payment system services for banks in their district. There are 12 members of the Federal Open Market Committee, or FOMC. This always includes the 7 members of the Board of Governors and the President of the Federal Reserve Bank of New York. The remaining 4 members come from a rotating group of the remaining Federal Reserve Bank presidents. The main task of the FOMC is to set interest rate targets. This is commonly referred to monetary policy. What have we learned in this lesson? Before central banks existed, paper money was often issued privately. In this system, the money supply was unpredictable and bank runs occurred frequently. To control the money supply and to ensure the stability of the banking system, central banks were founded. Central banks are also the lender of last resort that will lend cash to banks in times of crisis. In the United States, the Federal Reserve System fulfills these functions through 3 entities: the Board of Governors, 12 Federal Reserve banks, and the Federal Open Market Committee.